Shanti Ekambaram joining us, President, Consumer Banking at Kotak Mahindra Bank. Shanti, great to have you with us this morning. And, we wanted to really bring up the concerns with regards to whether or not the consumer finance boom has peaked out. We've been getting certain comments, from the likes of a Chris Wood and otherwise, and we've also been seeing that slight slowdown in earnings this time around. Let me first get your main takeaway with regards to whether or not you are seeing that slowdown, and if so, what you feel are the primary factors driving this trend.
Hi, morning. So the slowdown actually has been visible for some time now. And it really started post the busy season last year. Even if you saw the busy season last November, December, it wasn't as robust as one would have liked it to be, and it really started with the auto segment. Over the last 2 quarters, you've really seen auto as a segment, the slowdown being manifested really in large numbers. I think it is very closely linked to the underlying economy. It started with cars, it's now in commercial vehicles, construction equipment, and so on and so forth. I think in the last, real estate has always been, in a difficult situation for more than a year. However, housing at the affordable housing segment, as well as housing in some cities where there are genuine buyers, has seen demand post-RERA, post other, regulatory compliances. I think you've seen that continue to be steady, but still down overall. I think in the last 3 or 4 months, segments like consumer durables, which otherwise, were holding up, are also beginning to see a little bit of a slowdown. So the way I see it is that, yes, there has been a slowdown in consumption. Maybe it's over the last 6 months, but it's becoming more visible. In my view, I'd very closely link it to the overall economic, macroeconomic situation where you are seeing growth slow down. When I look at consumption, I basically divide it into urban, rural, and you have the business and the salaried class. Both rural and urban have been seeing the slowdown. If you look at the business class, you know what SMEs, MSMEs are going through, and there is a slowdown in consumption. And the salaried class, no new demand is being created, and if industries are going to go through pain, there could be some job losses. So I think there is a caution that has come into consumption, which is visible right now.
Yeah, indeed. And, if you just look at the commentary from an HDFC Bank, or for that matter, the kind of slowdown at HDFC Bank in Q1, which wiped out nearly about 25,000 crore rupees of market cap in just one day. That clearly is indicative of the kind of extent of the mass slowdown that one is seeing in domestic consumer spending trends. But Shanti, you also have been reducing your exposure to consumer bets like Arvind Fashions and adding insurance and other financial companies. Tell us a little bit about the thought process here, given the current scenario.
I think, as the economic growth slows down, you are going to see this continue. And I think it requires 2-3 things. One, as infrastructure spending by the government picks up and some investment by private sector, which is not seen right now, I am hoping that there will be some revival of demand. But as it looks right now, there is a global economic slowdown, there is a domestic economic slowdown, and you are beginning to see that now gather steam. So I think it requires, the macroeconomic stability and revival for us to see some kind of consumption, slow down, at least stabilize, revive, and start upwards.
Just to drag that point further, Shanti, could you just give us a view as to what you expect in terms of the overall liquidity situation? Because as of now, we have seen a massive FII exodus. Do you think that there are brighter opportunities within the emerging markets pack for the foreign investor community, or we will see India get back on track? And what are the factors do you think that would lead to that?
So I think from a market perspective, there is a certain situation why you have seen a large outflow from FIIs. And it is both India's growth as well as certain budget announcements that may have caused this. But I think if you look at the broader markets, it's just still the top 6 or 7 stocks that have been moving the market for the last 2 quarters. And as you see slowdown at a larger level, that has really started slowing down and people have significant ownership. I think for even markets to continue, India from a medium-term perspective looks extremely attractive. We still have, 7% growth versus what you're seeing in the world in certain areas, 0 or even negative growth or negative interest rates. So given that from a medium-term perspective, India is still fine, but I think we need investment. We need that investment to kickstart the economy. We need more job creation that will hopefully come from the investment. We need to build out massive infrastructure. I think a lot is being said and discussed, but there is a lead and a lag effect, and I'm hoping that this busy season we will hopefully try and see some of that slowly come back into the market.
Could you also tell us then, Shanti, about some of your other areas where you anticipate reduced exposure going forward, and where is it that you would be scaling up positions in the next year, given the kind of market environment we're currently in?
So if you look at the consumer space, home continues to be stable. Cars, the demand has come down, but it's still a stable segment from a, exposure perspective. I think the only area that is showing some early caution is really the whole unsecured personal loans and even to some extent credit cards, where, it is not a runaway situation, but you're beginning to see a certain amount of caution. So I think consumer from a segment perspective will still continue to be a focus for us and across banks. But we would sort of look at, what you call the secured, the home, the individual versus, what you call some of the unsecured lending as you see the situation pan out. Now, if, for example, by the busy season you see things sort of stable, then you would see how you take it. But there is still underlying consumption demand. It's not sort of completely collapsed, but it has slowed down.
Sure. Shanti, everyone's been waiting to see when that transmission of the rate cuts actually starts to have a visible impact, also expecting deeper cuts going forward. What's your anticipation on monetary policy, and how do you also see the impact of that playing out?
So I think 25 basis points rate cut in the monetary policy is almost, I think, a foregone conclusion, and that is certainly my expectation. I think the interest rates, if you look at the last 3 to 4 quarters, have certainly trended down. I mean, you take cars, for example. Look at the new cars. The rates are, possibly at all-time low, but that doesn't mean more cars are selling. There is still a problem. So I think the rates have been coming down. Banks have also been bringing down some amount of their deposit rate, though the government small saving rates is still quite high. So I think you've begun to see transmission. Transmission has happened and will continue to happen. For now, I can say that 25 basis points in August policy is for sure. Thereafter, it will be data dependent. One, we've seen that monsoons, though a late start, had reasonably caught up. So that should ensure, agriculture and, some amount of, consumption even in the rural areas should come back. So thereafter, it will be based on data, both on inflation, growth, and it is a balance between the two.
Okay, and what's the outlook when it comes to the PSUs as well as the overall NBFCs, given the acute stress we've seen here?
So I think the government has announced a large capitalization of the public sector undertakings. So that should give them a shot in the arm to be able to look at, lending. There are many other issues with governance structures, etc., which is a different story, but at least that they would get adequate capital to be able to start lending again. I think NBFCs is a different story. I think people have to sort of get over the current troubles, both liquidity, solvency across various companies. There are tighter regulations that are coming in, and I think the whole business model will have to be rejigged and worked within the framework, which in my mind should take another 6 to maybe maximum 12 months. But the PSU certainly, with a dose of capital, you should start seeing them back in the market in terms of lending. In my mind, this whole process, there is a lead and a lag, so it will take the next 6 to 12 months. The NBFC may be a little deeper, but PSUs maybe in the next 6 months or so. We'll have to wait and watch.
All right. Okay. Shanti, we'll leave it there. Thanks so much for joining us this morning and taking us through your view on things as they stand currently. And as you said, there has been an impact, but it's not necessarily drastic, and perhaps that's the takeaway coming in there.